what I'm most concerned about is the complacency, widespread complacency that's out there, that we're going to get an elongated soft landing, or some economists say no landing, that there's no recession. But I think this recession nobody sees is actually staring us in the face. When you look at the history of recessions, they start actually with the unemployment rate right where it is today.
Welcome to Speak Up. I'm your host, Anthony Scaramucci, and today here on the Wealthion Network, I am joined by a dear friend of the network and somebody I see as an intellectual Sherpa on Wall Street, David Rosenberg. David is the founder and president of Rosenberg Research, and as many of you know, it's an economic consulting firm that he established in January of 2020. He and his team have been providing investors with great analysis and well-informed investment decisions for multiple decades, but on his own since 2020. It was an auspicious time to be starting that business, David. As a fellow entrepreneur, I'm sure that was exactly what you expected to go into a global pandemic a few months after you started the business. But in any event, thank you for coming back, and we always love having you on. I want to start with a little bit about yourself, because we're adding new viewers every month. Tell us a little bit about yourself, why you got on Wall Street, how you got focused on research, and then we'll go into some of the macro things.
Well, in terms of, the career path and making it on Bay Street in Toronto and then Wall Street, I fell into it more than anything else. It's not something that I really pursued. I didn't come out of school saying, "Wow, I want to be an economist on the street or even in the financial markets." There's nothing that we do, say, in the realm of economics, in terms of financial markets, that they ever teach you in college or university. So it was just like the books behind me. It was just one chapter after another. I started off my career actually working in the government in Ottawa at the Canada Mortgage and Housing Corporation, which is like America's version of Fannie Mae. And I was a housing economist, but I grew bored and tired of working in the public sector. And I just flooded my CV to all the chief economists at the big banks on Bay Street in Toronto. And I hit the lottery ticket at the Bank of Nova Scotia on October 19th, 1987. So I was grounded early, my first day as a street economist being on Black Monday. But I just quickly figured out after that, being an economist, being a market economist, and the audience, say that you and I have, just combined a lot of the talents that I bring to the table, and not just research, but also analysis and writing, and then being able to communicate a view, and then realizing that your effectiveness as an economist on the street is you don't stop at GDP. You have to take every forecast that you make on the economy and attach a market call to it. So it was just basically a game of snakes and ladders in my career, and how I ended up where I am, how I ended up as the chief economist to Merrill Lynch. To this day, I still don't even know how that happened. It was never something that I aspired to, but I guess to some extent there's always a lot of luck involved and being at the right place at the right time.
Well, I mean, it's interesting because I think as we get older, we get humbled by life, and we realize that some of our success is based on our decisions, and some of our success is based on luck, and also bad things happen to us that we can't control either. So it's a lot of things are going on, but you have been amazing at spotting things early. You've been amazing at looking at data and synthesizing trends, going back to many different times, but really the 2007, 2008 global financial crisis. You correctly predicted the recession in 2007. and you let people know that you were very worried about the subprime markets, and then the ensuing explosion there. What do you see right now? Do you see echoes of that, or the Fed has it under control, or is there a black swan out there that we're not thinking about that we should be thinking about?
Well, I mean, if I could identify the black swan, it wouldn't be a black swan anymore.
Oh, well, that's
And
true.
frankly, when I was making the call in '06 and '07, he was looking at all the excesses in the residential real estate market and how household balance sheets were so radically exposed to residential real estate. And then coming off a pernicious interest rate cycle from the summer of 2004 to the summer of 2006, actually a very similar interest rate cycle that we just endured in the past couple of years. You'd have asked me back in '06, what's the black swan event? And I would have said, well, all I can tell you is that periods of national home price deflation, never end well. And I thought there was going to be a credit crunch, but then I think there was going to be, significant bank failures, that I think that the whole global system was going to freeze up. I didn't predict at the time that my own company that I worked for, Merrill Lynch, was going to have to get swallowed up by Bank of America. So you could have asked me about the black swan back then, and I would never have thought about how bad it was going to get, but I knew it was going to be bad for the economy. And I knew that interest rates were going to go down and that we're going to have a bear market in equities. But it went far further than I ever thought. I got the call right back in 2001. I was viewed as a Luddite back in the late 1990s because, of course, I didn't understand the internet wave and the dot coms, but I saw a bubble brewing then too. But if you'd asked me back in 2000, well, what's the black swan? I wouldn't have said WorldCom and Enron. However, I would say this time around, what I'm most concerned about is the widespread complacency that's out there, that we're going to get an elongated soft landing, or some economists say no landing, that there's no recession. And, what's interesting is that people think that the financial crises that we get generate the conditions for the recession, but actually it's the other way around. It's the recession that caused the impairment in cash flows that triggers the financial crisis, and that's when you get this negative loop that causes the Fed each and every cycle to take rates down towards zero, and then the last couple of cycles embarking on balance sheet expansion. So I think that the big concern I have right now, it's not about that households are overly exposed to real estate. It's that they're overly exposed to the equity market. And that has me very concerned. The boom, or I could call it a bubble, in passive index investing, when people are just blindly buying equities without doing any homework, any analysis, any work on valuation. Nobody cares about valuations anymore. And so the fact that over half the market cap today is passive index investing has me concerned. The fact that equities on the household balance sheet look like what residential real estate on the household balance sheet did back in the mid to late 2000s. The household sector, and it's been the right call. But will it remain the right call? And what happens if we go into a bear market in equities? So never before, not even the late 1990s, has everything rested on this bull market in equities being perpetuated, as far as what it means for household balance sheets and then confidence in spending. So that's my big concern, is that you have, in terms of the household financial asset mix, over 70% is in equities. Hardly anybody owns any treasuries. You have maybe 10% that's in cash. And the layered on concern is the aging, but not necessarily aged, baby boomers. They should be closer to 30 to 40% of their portfolio in equities. They're over 60%. So I'm concerned about the complacency. I'm concerned about the fact that through this significant bull market, nobody has rebalanced their portfolios. Nobody's rebalanced. And it's that mismatch especially between age and composition of the asset mix and portfolio that has me most concerned.
Okay, so it's a different time then. You're worried about. Uh, let me say it in my own words and see if I've got you right. It's a top heavy market, 6, 7, 8 stocks moving the market. Everyone's dumped their money into those indexes, and valuations are historically based on different metrics very high. And even if the Fed moves a couple hundred basis points, still, if you looked at it from that perspective, my old boss Leon Cooperman would say, okay, still very high. And so, bull markets don't end from that. They end from the exhilarating blow off and then the ensuing depression. But it's still a metric that you'd look at and say, okay, it would cause some, a pause for concern of you, a cause of concern. But what do you think about the Fed? Be in the mind of the Fed for a second and say, okay, what's the Fed thinking? They have to be worried about similar things because you and I are worried about them, and we're old enough now to be more worried and less oblivious. What do you think the Fed's thinking?
Well, I think the Fed is thinking about the path towards getting the funds rate back towards neutral, whatever that number is. It's inherently impossible to observe, but at least they provide an estimate in their dot plots, and they moved it up fractionally to 2 7/8. So the question for me isn't the destination; it's really the timing. We heard from Powell. Powell is there saying, we're not going to be going in 50 basis point increments. We're comfortable going in 25. And I'm not going to debate the size of the moves or whether they skip a meeting or don't skip a meeting. I have a good feeling where the destination is. And by the way, I have a sneaking suspicion that as I draw the probability curve, we're going to close this cycle with the funds rate well below where the perceived estimate of neutral is. So what's the Fed? The Fed is thinking this. And actually, Austin Goolsbee at the Chicago Fed, and I actually think he's the most thoughtful FOMC member by a country mile, gave a speech last week in Chicago where he basically said that if he could freeze where the unemployment rate is right now and where underlying inflation is right now, he would do it in a heartbeat. Otherwise saying, we pretty well got to where we want to be in terms of the dual mandate of full employment and price stability. But the odd man out here is the funds rate. Then therefore, what's the funds rate doing more than 200 basis points above neutral? Because if we're in that Goldilocks of balance between inflation on one hand and unemployment on the other, we should be below 3% on the funds rate today. And that's an additional concern I have, is just how far the Fed has let itself get behind the economic curve. You see, it's not evident to the naked eye today any more than it was when the Fed lagged so far behind the inflation cycle. Back when the Fed lagged behind the inflation cycle in 2021 into early 2022, it didn't seem like inflation was going to become a problem, and it became a big problem. And now nobody believes the economy is going to be a big problem, but I do think it's going to become a big problem. That's where my big concern is on the equity market, because if it goes down, we're going to get this double negative impact from the negative effect, the negative wealth effect on household spending, which is roughly 70% of GDP. And that's when you get this do loop of markets and the economy exacerbating each other towards the downside. Nobody's thinking about that. Nobody's talking about it. Nobody's forecasting it, because everybody has got Goldilocks and the soft landing or no landing as their base case. That is the widespread consensus. You asked before, what's the black swan? I don't know what the black swan is in terms of what we can pinpoint. I mean, we know that credit cards are certainly an item of radical excess. Auto loans, default rates there in both cases are at their highest level in 13 years. And I'm not going to say that there's anything out there that's going to bring down a bank. That's not going to happen, and lightning doesn't strike twice. But you've had 10 recessions since 1950, not every one of them has to be part and parcel of a financial calamity. Everybody always fights the last war and is asking me, could this be another 2007, 2008? No, it's not going to be. And we had, a recession, a mild recession. It wasn't a mild recession for the stock market, but it was a mild recession for GDP back in, 2000, 2001. It was actually a short and mild recession. But of course, the valuations were so extreme that it wasn't that mild a recession for the stock market. It didn't involve a calamity. No bank went down in that period. So I'd be the first to tell you that the banks are well capitalized and well guarded. I don't think we're going to get a cascading financial crisis. But as far as the economy is concerned, as far as what this could mean for society, because I have a problem. Everybody is all in on this bull market. And I come back to that. Nobody's rebalanced. There is a massive bear market in rational thought. And the degree of concentration, not just within the stock market, but the degree of concentration on household balance sheets, I come back to that, especially for the 78 million pig in a python called the boomers that have dominated everything from economics to politics to finance. And we can talk about the Gen Z crowd, and we can talk about all the echo boomers, and we can talk about Generation Y, but it's the boomers that still basically are the dominant force. And I cannot believe how exposed they are to such a risky asset class when they should be de-risking their portfolio. That's really my principal concern. Come back to that. But my other big concern is that, and it's not, again, evident to the naked eye, is just how high interest rates are. And the Fed is, I think, being quite sanguine about the whole thing. You have Powell telling you in their forecast from a couple of weeks ago that we're going to have the unemployment rate go up 100 basis points from the low. We're going to go from 3.4 to 4.4. Oh, Anthony, I get this all the time, but the unemployment rate is so low. But you know that when you look at the history of recessions, they start actually with the unemployment rate right where it is today. People don't know that. It's not about the level. It's about the change. So everybody's preaching a soft landing, but if it's a soft landing in the economy, the unemployment rate goes up between 30 and 50 basis points from the low. It doesn't go up 100 basis points. We're already up 80 basis points from the low. And so the Fed's telling you soft landing, but the unemployment is going up a full percentage point. Whereas 100% of the time in the past, when you've had the unemployment rate up that much, you've gone into recession. And then when you go up 100 basis points in the unemployment rate, you never stop there. You never once stop there. You keep on going. Eventually it does stop when the Fed or say fiscal policy gets aggressive enough. And when you're not in a soft landing and the unemployment rate goes above 100 basis points, it peaks out 360 basis points above the cycle low. So you know what I'm saying here? I'm saying the unemployment rate is going to go to 7% in the next year or two. Well, so then what do you do as an economist? Well, you have to map out what the lags are from that degree of excess capacity in the labor market towards something very critical to the economy, which is called wages. So wages decelerate. And all the folks out there that talk about how great household balance sheets are, remember that the denominator is income. And as unemployment rate rises, that denominator goes down, which means your dead income goes up. And the Fed has lagged too far behind. And something else that concerns me when we talk about, say, black swans or the big risks is just as the Fed stayed too easy for too long in 2001 into 2002, they stayed too tight for too long. Like I said, it's not evident in the current economic data. This is all about what is the crystal ball telling me about the future. And when you're taking a look at where is the normalized level of interest rates in the economy, look, the 5-year average of the Fed funds rate, of business loan rates, residential mortgages, auto loans, we're between 200 and 300 basis points above the normalized level. So you do not complete an easing cycle with the level of interest rates this far above the normalized level. you actually go to and then through the normalized level, which means that rates have a long way to go. They have a long way to go. That's my highest conviction call, is that interest rates and treasury yields have tremendous room to move lower from where they are today.
This show is sponsored by BetterHelp. A rate cut has arrived. It finally happened, and it was only 4 years in the making. The Fed has cut rates by 50 basis points. It surprised some, but many cheered it. For sure, there will be some bumps in the economy going forward. There always are. And maybe there are bumps in your personal life financially that are weighing on you. Or maybe there are other things on your mind keeping you awake at night. It happens to all of us. We walk around with the weight of the world on our shoulders, and we look at others thinking their lives are perfect with no worries or cares in the world. Of course, that isn't true. Everyone has worries and things they can't get off their mind. You can't let those things get in the way of the fun things in life, the things you are curious about and want to tackle. Talking to someone helps to ease some of the negative thoughts and gain a new perspective on some of the things that are floating around our heads. And believe me, there's plenty. If you need to talk to a professional or you are thinking about giving therapy a try, give BetterHelp a try. It's easy, online, convenient, and flexible to fit your schedule. Just fill out the questionnaire and get matched to a licensed therapist anytime. Rediscover your curiosity with BetterHelp. Visit BetterHelp.com/Wealthion today to get 10% off your first month. That's BetterHelp, HELP.com/Wealthion. Okay, and you I mean, the content's so good that I'm not interrupting at all, but I just want to get you to react to something. And so this is Ben Bernanke talking about the mortgage crisis in 2007. He's at a testimony in the Congress. Market rallies on this. He says, I'm not worried about the mortgage crisis. They say, why? It's a $90 billion crisis. He actually uses the words, I can ring fence the problem and the Fed can figure out a way to absorb the bad loans and we'll clean up the economy. But he waits. And this $90 billion crisis, the prairie fire starts, very similar to what you're saying about how things can get extended and things could be made worse just by the reflexivity of markets. We go from a $90 billion problem to a $6 trillion global financial crisis. So I guess everything that you're saying, policymakers have to think about, and a lot of these policymakers have been around since the last crisis. So in your research and in your discussions with people, are they thinking along the lines of David Rosenberg, or how are they thinking?
Well, if you go back to that period, right, and of course, Bernanke also said, right, the problems of subprime will remain contained. Remember, contained?
I remember the word contained.
Yes.
I remember the word ring fence.
Neville
Trust me,
Chamberlain.
I was on every syllable of every sentence that he said back in those days.
It was Neville Chamberlain's Peace in Our Time.
Yes.
But he also said that home prices nationally never go down, and that was another, Charlie Brown and Lucy episode with the football. So you go back to that period in 2007, and I am certain that the only people that were calling for recession were me and Dick Berner over at Morgan Stanley for different reasons. But Anthony, everybody was in the soft landing camp back then. Okay, that was the widespread consensus narrative. And in fact, the consensus did not shift towards a recession view until the summer of 2008, when the recession was already 8 months old. Sometime between the conservatorship of Fannie and Freddie to the failure of Lehman and AIG and Merrill, sometime in the consensus finally got it, but it was too late. So you're asking me, do I feel like the lone wolf? I've been here before, 100%. When I was back at Merrill Canada in the early 2000s, I was laughed at for calling a recession in 2000. And you're right, when you said before that I'm early, I'm always early. sometimes too early to a fault. However, the thing is about bull markets, right? The bull markets are an escalator going up, and a bear market's an elevator going down, and the next thing you know, you have your head sliced off. So yeah, I am concerned. And I can't say that I'm going to sit here and talk about where where what sort of financial crisis we can get out of this. It's not something that I can't identify it right now. I just know that we have an economy that is inherently interest sensitive and credit sensitive. And we've had a whole bunch of other things, from fiscal policy and people having locked in those low rates. We've had the lag sort of clogged up. Now, interest rates, the interest rate cycle, the market cycle, the economic cycle, these are centrifugal forces. They're sine waves over time that overlap with each other, but they're not always necessarily in sync, but they overlap with each other. And I have continued to say, and I say today, that there is no get out of jail free card from the most pernicious tightening cycle by the Fed since the Volcker era. There are things, and including, I didn't mention, of course, the excess savings file. When you dole out a $2 trillion stimulus check to anybody with a pulse back in the winter months of 2021, that is going to provide a lot of firepower for an extended period of time. Just like, look how long it took for the recession to take place back in 2007. It took years because everybody, till the last second, wasn't about fiscal stimulus. It was about extracting home equity and cash out refinancings right to the last drop, and the last drop ended in December 2007. So there's something else that is on my mind, is that people have forgotten about, that the lags between rates and the economy are long. They're long. People say, well, they're long and variable. They're just long. And historically, it's about 30 months from the time of the first rate hike, remember, which was back in March of 2022, to the timing of the recession. It's not 30 days and it's not 30 weeks, it's 30 months. Well, we're pretty well staring it in the face right now. I mean, just think back to that last cycle where I was a laughingstock at Merrill Lynch for daring to call for recession. Back then, people dreamed of different reasons why the business cycle has been repealed. The Fed started hiking rates in June of 2004. Well, the recession started in December of 2007. How is that different than right now? Now, I would say that some of us out there that were calling for recession last year, it didn't come. We're being tempestuous and impatient. But, to say that we're not going to have a recession, and of course the Fed believes that too. Somehow the Fed wants to have it both ways. We're going to forecast a 100 basis point increase in the unemployment rate, but there'll be no recession, which has never happened before. But there's a lot of people that believe that this time is different. That is the one thing I hear consistently from colleagues, from clients, from just watching Bubble Vision, that this is a different sort of a cycle. And when I hear that, I head for the hills, because every cycle has its similarities and it has its differences. But the one thing that has never changed over time is the powerful impact that interest rates have on the economy. And the lags are long. But I think this recession nobody sees is actually staring us in the face. We had second quarter GDP growth of 3%, and people are just dancing around the kitchen table without realizing, firstly, that GDP does not even go into the NBER definition of a recession, for one thing. Of course, we're just retently focused on GDP. However, when you look at the first quarter of every recession, going back to 1950, the average quarter the recession starts is 2%, with a plus sign, not a minus sign. So I just find that, where is this black swan? This black swan is in this incredibly entrenched complacency that the business cycle has been repealed, and that therefore I am not going to rebalance my portfolio, but I'll be all in on one asset class and really one index, otherwise known as the S&P 500.
So we're going to take questions from the audience, but I think it's just a brilliant exposition of where we are. And of course, I want to ask you before we say goodbye a little bit about the election, your thoughts there. But let's take some questions from the audience first, and then we'll finish up with that. Let's start with the first question. David, are there specific defensive sectors that you recommend investors consider? This is Scott E. from Canada.
Yeah, I think that my preference is to be in the defense of rate sensitives. And of course, look, I operate in a world where your assumptions drive your conclusions. If your assumptions are wrong, your conclusions are going to be wrong. But we are going into a new declining interest rate cycle. Therefore, you'd want to be in utilities. You'd want to be in selective REITs. You'd want to be in telecom. You want to be in non-cyclical areas of the market with solid dividend yields and solid dividend payout ratios. Ordinarily, you'd say to me, well, if rates are coming down, are you not bullish on growth stocks since they're the longest duration stocks in the market? And ordinarily, I would be if it weren't for the fact that the valuations are just too expensive for my liking. But right now, those are the sectors that I would be focused on mostly in the equity portfolio right now.
Okay.
What I call the bonds and drag.
Okay. Let's go to the next one. You think we're at risk of stagflation? This is Jason R. from Minnesota.
No, I don't think we're at a risk of stagflation. I think we are at risk of a classic recession. I think just looking at the charts and looking at the leading indicators, inflation is melting away. It will continue to melt away. I can tell you that then in the next 3 months, the frustrating and stubborn rental components are going to start to slow down more materially. And the auto insurance costs that caused the Fed to have so much concern at the start of the year, margins in the auto insurance industry have moved up high enough that that's not going to be a factor. And then, you're taking a look at, right now, of course, you've had some of the base metals moving up because of what's happened in China. But look, why is WTI flirting with $70 a barrel? What happened? All the oil bulls told us we're going to be $100, $120 by now. That's not happening. So oil prices coming down has all sorts of other spin-offs on business costs. I cannot wrap stagflation around my view when productivity growth in the United States is running close to 3%. That's actually where Dave Rosenberg, the bull, starts to comment on some of the positives. How is it that productivity, and this is even before any benefits from AI, a lot of the productivity growth is coming from actually what happened during COVID, post-COVID. Usually stagflation involves no capital formation and no productivity. But productivity right now is one of the bright spots for the U.S. economy, which is why I think inflation has lots of room to come down, both from a cost perspective and from a demand perspective. But productivity growth where it is right now, no, stagflation is not a problem. I think that we might even be talking a year from now, Anthony, we're talking about deflation. Okay, I think that we will see, the Fed overdid it as much on the easing as it did on the tightening. So I would say that recession is a more principal risk, disinflation / deflation more principal risk. I'm not going to put zero odds on anything, but stagflation is pretty well at the bottom of my worry list.
Okay. All right, let's go to the next one. Given the fiscal spending is still high, will the Fed's policy alone be able to curb inflation effectively? George H., New Jersey.
Well, that's a legitimate question. But you see, what is inflation? Inflation is a rate of change. Paul Volcker is known as the great inflation dragon slayer. But during his 8-year tenure, the price level went up 60%. What he did was he brought inflation down from 12 down to 3. So the level of spending is high. Ergo, the level of prices is high. There's no doubt about that. But what drives markets are the rate of change. And the rate of change in terms of fiscal stimulus is slowing. I'm not saying the stimulus isn't there in terms of level, it certainly is, but it's the change at the margin that matters. Now, I will be very concerned, okay, about my outlook on this, and that's why it's a great question, based on what happens on November the 5th. And I'm not talking so much about is it going to be Harris or is it going to be Trump? Neither one of them is really paying much attention to deficits and debts. But if we get one of those presidents in the White House and it's a clean sweep, I'm going to be really worried about my call. And I'm willing to change it. If we have one party rule, because that one party rule, especially when you consider Kamala Harris is willing to get rid of the filibuster, which means anything is going to go in the Senate. But in both cases, there's going to be tremendous additional fiscal stimulus, not in level terms for rate of change, that's going to cause me to scurry heading into the morning on November the 8th and change my forecast. I think that we'll have split government. It's my expectation. It's actually my hope. I think that's would be best for America. However, if we don't, then the fiscal stimulus creating aggregate demand growth relative to supply is going to cause me to reconsider my inflation call 100%.
Okay. I mean, it's great commentary. Let's keep going. Do you see opportunities in emerging markets given the current macro environment? This is Lauren R. from Florida.
Well, that's a great question right now that the Chinese stock market has moved from the floor and into a technical new bull market. I think that the emerging markets, I mean, China trading with a 10 multiple, Hong Kong with an 8 multiple. These markets are very cheap. Historically, emerging markets are good places to be when interest rates are coming down. What has me concerned is if we go into a global recession, and I'm really concerned that nobody has this in their forecasts. Nobody. Then what happens is that emerging markets become markets that you can't emerge from in an emergency. So the problem I have with emerging markets has more to do with, if my forecast is right, you want to be extremely liquid. And the emerging markets, while very attractively priced on any virtual multiple basis, that's what concerns me. So I would tread very carefully. There's if we don't go into recession, and everything hinges on the recession call. If we don't go into recession, rates come down. So this comes down to really your personal view. If you don't have a recession view, the one thing we know for sure is rates are coming down. We just might not know by how much. Emerging markets will be a great place to be. I tend to be more conservative. I do still have a recession call, so I'm backing away from exposure to emerging markets for the most part, but a lot of that will come down to your own macro call. We avert a recession, rates coming down, looking at these valuations, emerging markets will be a great place to be, but I have a preference for liquidity right now, and that's why I'm sort of shying away from that group.
All right. Let's see. Any more questions? Just asking the producers. What's your view of gold? Charlie from California, David.
Right. Well, that's my wheelhouse. Been bullish on gold for 10 years. Was one of the first calls that I made when I formed Rosenberg Research back in early 2020, as you mentioned before, and I remain bullish. And it's interesting that the complexion of gold has completely changed. It's trading less as a commodity and more as a currency, Anthony. It's trading as a currency that is no government's liability. And so what was interesting to me in the past year is that gold hit a new high in every single major currency term. So its complexion is changing. The two tailwinds for gold, lower rates and a weaker dollar. And we're getting both. And so I can't give you a price target. People ask me, will we get to $3,000? I think we'll blow through that. But gold is something that's very difficult to value. Just you mentioned Bitcoin before. Hard to value these things that don't have a cash flow stream, right? However, I'll start to turn bearish on gold, or certainly uh, talk about how I'm pulling back on my bullish call once I see the tailwinds subside, and that will be the interest rate cycle and the dollar cycle. Now, even if those things happen, there are other things occurring that should make you bullish on a fund flow perspective, and that is the fact that global central banks, by the way, not just the BRICS, but increasingly developed country central banks, after years and years of depleting their gold reserves, are now diversifying back into gold. And the one thing we know from QE is that you don't want to fight central banks with deep pockets. But that's third on the list in terms of why I'm bullish. We're in a bear market on the dollar. Certainly, if not a bear market, a correction phase in the dollar as the Fed plays catch down to the rest of the world on interest rates. And rates coming down has a time-worn inverse relationship with the gold price. So I say stick with the program until these tailwinds become headwinds.
Let's go to the next question. I'm a big bull on gold. I appreciate you bringing up all those wise comments. Mets are winning. See, the Mets are, so David, unfortunately, I'm going to have to keep you on my show through the World Series because when we started this podcast, the Mets were losing and they've had an explosive comeback. So they're teasing me, but I live in a house of pain, which is why I'm a good Bitcoin investor. I can take pain, having been a 50-year Met fan. So before I let you go, though, just 30 seconds each. Donald Trump wins the presidency. What's good and bad about that economically? Is it all good, all bad, or what's the mixed bag? And then conversely, what happens to the economy if Vice President Harris ascends to the presidency?
Well, you set me up for ensuring that 100% of the viewers are going to be angry with me no matter what. Uh, I think the only negative that I see with Trump's economic plank is the size of the tariffs, and I don't think he'll go through with them. But it's just you see, the tariffs are not inflation in the sense that tariffs are not raised every single year. It'd be a price level shift, but it'll brutalize the economy if he goes ahead.
It would be regressive, not to jump on it, but it would also hurt lower middle income families harder than any other families.
Of that, there's no doubt. And look, he did embark on tariffs in his first presidency, but not this size. And then we don't know how much of it hits the foreign producer, how much of it hits retailer margins, and how much of it lands on the consumer. But either way, it's going to produce a big negative shock. I would highly advise against it, but I think again, and you know the president better than I do, that it sounds to me more tactical. I just don't think it's realistic. But that's the biggest negative part of his policy plank.
Okay.
I think cutting corporate tax rates to 15%, it sounds crazy to most people, but that's where the top marginal tax rate was for the business sector before World War II. And of course, tax rates go up, and then, well, they didn't start to come down until Reagan's epic tax reform in 1986. Right. So all he's really doing is saying, I'm taking actually the top corporate tax rate where it used to be back in like the early and mid 1930s. So I have no problem with that. And of course, he is the poster child for, well, hard to say poster child with somebody in their late 70s, but the poster child for deregulation. And so, people will say, well, the immigration wall against will constrict labor supply. But you know what? He did that from 2016 to 2020. We never got big inflation. We never got a wage spiral. And what happened was that a lot of unemployed Native Americans end up getting employed. So in actuality, I think his policies are probably over time would be less bad. That's how I would portray it vis-a-vis what the Democrats want to do in terms of principally raising top marginal rates to 28%. And people say, well, it's still low. No, it's not low anymore. When you count in all the state taxes and what happens with that policy is the net effective top marginal rate for the business sector that, let's face it, does most of the employing in the economy. It takes it above 40%. So all of a sudden, America, in terms of total net effective corporate tax rates, the Democrats take the America from being competitive to the very high end of the OECD scale. I don't think that's going to be very good news, because if you tax corporate income and you tax profits, what is employment and wages paid out of, Anthony? What are they paid out of? It's not money out of the sky, right? It's paid out of profits. So what you tax, you get less of. So out of everything, that's out there, I think that the Trump's tariffs would just be, would be a big price shock for the economy, but it wouldn't last more than a couple of quarters. Raising corporate tax rates at the margin are going to have more pernicious multiplier impacts on the economy than most people think.
Right, but we both know that a divided government is sometimes great, right? If you get a Democrat and a Republican Senate, not going to happen, and you won't get the Trump tariffs in place. I mean, he could put some in through executive action, but it still won't be as broad if he's the president and there's a Democratic Senate, which is why we love Wall Street loves divided government, as we both know. So, well, you've been a brilliant guest for us, and I just want to thank you again for joining us on Speak Up. And I may need you, even if I have to FaceTime you during the playoffs, David. I may need you, okay? You've been a great crutch to me as I've been dealing with the pain of living as a Met fan my whole life.
You see, that this is what I wanted to hear, because although I never planned to be an economist on Wall Street, I always planned to be your good luck charm.
All right. Yeah. I mean, you're also cheaper than my therapist, Rosenberg. So I want to point that out as well. But thank you very much for joining us.
Pleasure's all mine. Thank you very much.
If you like this video, you'll like this video as well. Check it out.